Welcome, curious minds, to the deep dive. Today, we're jumping into Eastman's Q2 2025 earnings call.
Yeah, and this one really highlights something interesting, doesn't it? This tension between the tough macro reality right now,
Right.
and their big long-term plans for transformation. It's like headwinds versus the future.
Exactly. So let's dig into it. The call was August 1st, 2025, pre-market. We heard from CEO Mark Costa and CFO Willie McLean.
And the market reaction was, well, pretty immediate, and not in a good way.
No, not really. Let's just lay out the headline numbers because they definitely set the tone.
Go for it.
Okay, so GAAP EPS, it dropped 38% year over year, came in at just $1.20 a share.
Oof. 38%.
Wow.
That's a big miss versus the street too, right?
Yeah.
They were looking for what, $1.59?
Yeah, exactly. A significant miss. And even adjusted EPS, which kind of cleans things up operationally,
Right.
that fell 8% to $1.60. Still missed consensus, which was about $1.73.
Okay.
Revenue was $2.287 billion. That was actually only a slight miss, down 3% year over year.
So revenue held up a bit better, relatively speaking. But what about profitability? EBIT.
Yeah. Adjusted EBIT, down 22% year over year to $275 million.
And that means margins took a hit too, I assume.
They did margin compression of 240 basis points. So 2.4 percentage points landed at 12%.
That 12% margin, it really tells you something, doesn't it? Even with their specialty products helping out, the costs and lower volumes are definitely squeezing them.
For sure. On the cash side, operating cash flow, OCF, was $233 million. Free cash flow, FCF, was around $100 million after CapEx.
Okay, so generating some cash still. Did they return much to shareholders?
They did, about $145 million, mostly dividends. But here's another thing investors watch closely. Net debt to EBITDA.
Leverage. Where did that land?
It ticked up 3.1 times now compared to 2.8 times a year ago.
Right, moving in the wrong direction there.
Yeah.
So yeah, you can see why the market wasn't thrilled with these numbers.
Definitely didn't inspire confidence.
So let's get into the why behind this. What did management actually say was driving these weaker results?
Well, the big culprits they pointed to were, first, tariff volatility, and second, just generally weak demand.
Tariff volatility. That's a tricky one because it's so external, hard to control.
Exactly. It just creates uncertainty, makes customers hesitant. Did they get specific on how the tariffs hit them?
It sounded more like a general pervasive factor making planning difficult and customers cautious. But interestingly, they did stress that their specialty product mix and their pricing strategy actually helped keep price versus cost flat.
Okay, that is interesting. So the value of those specialties is holding up even in this environment.
It seems so. It suggests their core strategy there is sound, giving them some cushion, even if the overall volumes are down.
Were there other issues? Maybe internal ones?
Yeah, it wasn't just the macro picture. They had an unplanned outage in chemical intermediates.
Oh, really? How much did that hurt?
About a $20 million drag on EBIT. So not insignificant, just one of those operational hiccups you can't really plan for.
Right. $20 million is a hit.
And then there was destocking. They specifically called out destocking in the fibers segment as contributing to lower volumes.
So customers just drawing down their existing inventory instead of buying new stuff?
Exactly. So you've got the tariffs, the weak demand, an operational issue, and destocking. It's kind of a perfect storm of headwinds.
Yeah, it really sounds like it. So facing all that, what's the plan? What are Costa and McLean doing about it?
They're definitely in what you'd call self-help mode, aggressively so. They announced a new cost-cutting program, an extra $75 to $100 million they're aiming to take out.
Okay, that's substantial. What else?
Inventory. They're targeting a big drawdown there, over $200 million in the second half of the year.
Right, get that cash off the balance sheet.
Yeah.
But doesn't that impact production?
It does. And they flagged that. They called it a utilization headwind.
A utilization headwind. Okay, can you break that down? What does that mean practically?
Sure. So basically, if you want to sell off the inventory you already have, you need to make less new stuff, right?
Right. Yeah. Run the plants less.
Exactly. Yeah. But you still have all those fixed costs for the plants, the buildings, the machinery, some staff. When you spread those fixed costs over fewer units produced,
the cost per unit goes up. Hits profitability.
Precisely. So drawing down inventory is great for generating cash right now, which they clearly need, but it temporarily makes them look less efficient on a per unit basis and can lower earnings in the short term.
Got it. So it's a strategic choice. Cash now, potentially lower earnings now, hoping for better efficiency later when they ramp back up.
That seems to be the play. Cash generation is absolutely the priority in this environment.
Makes sense. But you mentioned their long-term plans earlier, especially the circular economy stuff. Is this focus on immediate cash going to slow down that big transformation? That requires investment, right?
That's the million-dollar question, isn't it?
Mhm.
Management seems to be framing this as a temporary thing, like batten down the hatches, generate cash internally to weather the storm, and then reinvest. But, the risk is always that temporary becomes longer. What was encouraging, though, was the news from their big circular economy project, the Kingsport methanolysis plant.
Ah, yes, the chemical recycling facility. How's that doing amidst all this gloom?
Surprisingly well, actually. It hit new production records. They said it reached 105% of its design capacity.
Wow, 105%. How does that even work?
Well, it means they're running it incredibly efficiently, likely finding ways to squeeze out more production than originally planned. And they even see potential to debottleneck it further, maybe get to 130% capacity or more.
That's impressive. Shows the tech is working.
Definitely. And this unit apparently produced 2.5 times the recycled output it did in all of 2024. So it's really scaling up. It's not just a concept anymore.
Okay, that is a genuine bright spot. Are they thinking about the next one already?
They are. They mentioned evaluating a second site, potentially one with lower capital expenditure, which would be smart right now. They're hoping for engineering approval maybe in the first half of 2026.
So the long-term vision is still moving forward despite the current pain.
It seems so. And they said customer engagement on the recycled materials side is still really high. Major brands are apparently making commitments for next year.
Even with the macro slowdown, why is that holding up so well?
Well, part of it seems to be the limitations of traditional mechanical recycling. For certain complex plastics, it just doesn't work well. Chemical recycling, like Eastman's methanolysis, can handle those.
So it fills a specific need that's becoming more critical for brands hitting their sustainability targets.
Exactly. It's less of a nice to have and more of a must have for certain applications. It really validates their niche.
Yeah, that makes sense. Okay, so a tough Q2, but some positive signs on the strategic front. What about the outlook? What did they guide for Q3 and the rest of the year?
For Q3, they're looking at adjusted EPS around $1.25. So even lower than Q2's adjusted $1.60.
Ouch, another step down expected.
Yeah. But they did reaffirm their full-year operating cash flow target, still aiming for approximately $1 billion.
Okay, so that cash focus remains paramount. What about full-year earnings? Did they give an EPS guide for the whole year?
No. And that was notable. Given the tariff uncertainty, they decided not to provide a full-year EPS forecast.
Wow, okay, pulling the full-year guide, that really speaks volumes about how murky the waters are, doesn't it?
It absolutely does. It signals just how unpredictable things feel, especially with those tariffs hanging over everything. Makes it incredibly hard to model earnings accurately.
But they must have said something about the longer term, beyond Q3.
They did offer some hope. They talked about anticipating demand normalization in 2026, once the trade friction hopefully eases.
So looking past the immediate pain towards next year.
Right. And they expect earnings to be materially better next year. They think the cost cuts and the tailwind they'll get from having lower inventory and ramping up utilization again will really help.
Assuming the demand actually comes back, of course.
Assuming demand comes back. That's the key assumption.
Okay, so let's put this all into context for someone looking at the stock. How has the market reacted overall, beyond just the immediate post-earnings drop?
Well, it hasn't been pretty. The stock performance has been quite poor, frankly. Down 26% in the last month alone.
26% in 1 month.
Yeah, down 25% over 3 months, and down a staggering 40% over the past year.
40%. Wow. How does that compare to the sector?
It's significant underperformance. The main materials ETF, XLB, has actually been positive over the same time frame. So Eastman is lagging badly.
Which tells you the market sees company-specific issues here, not just broad sector weakness, although there is sector weakness too, right?
Oh, absolutely. The global chemicals industry is definitely still in a downturn. Destocking is a big theme, especially in auto and construction. We've seen Eastman's peers also missing on volume numbers.
So it is a tough neighborhood right now.
It really is. It's not just an Eastman story, even though they seem to be getting hit particularly hard right now.
What are the analysts saying? The sell side.
Pretty cautious, as you'd expect. UBS cut their estimates and price target. Their take was basically tariffs trumping self-help.
Ouch.
Yeah. Bank of America gave them credit for the cost actions, called them credible, but said it's just not enough to offset the volume pain.
So a consensus that the headwinds are just too strong right now. What about the buy side or media view? Any different takes?
A little more nuanced, perhaps. Some value investors are looking at the dividend yield. It's around 4.6% now.
That's pretty attractive.
Yeah, and the valuation. The forward PE ratio is below 10. So some might see that as potential support, maybe arguing it's oversold. CNBC kind of framed the drop as tariff collateral damage.
Right. But the core tension remains, doesn't it? Management is talking up the long-term circular economy story.
While the market is laser focused on the immediate cash flow risks and that Q3 step down in earnings they guided to, it's that classic short-term versus long-term battle playing out.
Is the market just being impatient, you think, or are the near-term risks genuinely that concerning?
I think it's a bit of both, honestly. The risks are real. Tariffs, demand, cash flow, you can't ignore those. But the potential in the circular economy is also real, driven by regulation and consumer shifts.
Right.
The question is, can Eastman navigate this rough patch without damaging that long-term potential?
Right. So what needs to happen for the stock to potentially re-rate higher? What are investors looking for?
Clear signals. First, signs that volumes have actually bottomed out, some stabilization. Second, and this is huge, some kind of resolution or clarity on the tariff situation. That uncertainty needs to lift.
Okay.
Third, they need to execute flawlessly on those cost cuts and cash generation plans they announced. Show they can deliver on the self-help. And then that December investor day is going to be important.
For updates on the circular economy progress.
Exactly. That's their chance to really sell the long-term vision again. But it's worth remembering, even in this tough quarter, their specialty additives business did grow sales based on price and mix.
Ah, so that core strength is still there, even if it's getting overshadowed.
Right. It shows their innovation and pricing power haven't completely vanished.
Okay, let's shift gears. Time for our not financial advice segment. And let me just say this very clearly. Nothing we discuss here is a recommendation to buy or sell anything. It's purely for informational and maybe entertainment purposes. Always do your own research.
Absolutely. Crystal clear disclaimer.
So with that big caveat, hit us with an outrageous but plausible trade idea based on everything we've just discussed about Eastman.
Okay, so given how badly the market hammered the stock on the tariff news and the weak outlook, you could think about a short-term bearish options play.
Maybe buying some puts.
Right, betting on continued near-term weakness or volatility, hedging the downside.
Exactly, betting that the near-term pain isn't over yet. But here's the outrageous part. At the same time, you could start building a long-term bullish position, not just in Eastman maybe, but in a small basket of specialty chemical companies that have really strong pivots towards the circular economy. Eastman would be key in that basket. Whoa, okay, so short-term bearish, long-term bullish simultaneously. That feels contradictory. Why is that plausible, let alone outrageous?
Well, it's outrageous because you're essentially betting against the company's near-term prospects while betting on its long-term transformation, right when the market is screaming about the immediate problems. It feels wrong, like buying airlines in April 2020.
Okay, I see the outrageous part. What makes it plausible?
The rationale is acknowledging two different realities. Reality one, the market is punishing Eastman hard now for tariffs and macro weakness. That pain is real, hence the short-term hedge via puts. Reality two, management is taking action, cutting costs, managing cash, and that circular economy business is performing well, signing deals, and has huge long-term regulatory and customer tailwinds. So the low valuation, that sub 10x PE, and the 4.6% dividend, that provides a potential cushion longer term. The long bet is simply the chemical recycling and their specialty niches are uniquely valuable, and eventually the market will recognize that again once the current storm passes.
So it's a hedge against the near-term emotional market reaction while slowly building a position for a fundamental long-term recovery based on specific strategic strengths.
You got it. It's a wait-out-the-storm approach, but with an active tactical hedge.
Yeah.
It accepts the near-term market narrative while betting on a different long-term outcome driven by innovation and sustainability trends.
Quite the strategy. Definitely food for thought.
Okay, so wrapping up our deep dive into Eastman's Q2 2025 call. A really challenging quarter, no doubt about it. Significant misses, driven by a cocktail of tariffs, weak demand, and even an internal hiccup.
Yeah, but also clear action from management on costs and cash. And that persistent bright spot in the circular economy, with Kingsport doing well and customers staying engaged.
It really underscores how vital it is to look beyond just the headline numbers on these calls, to understand the drivers, the context, management's response.
Absolutely, the full picture. So as you digest all this, here's a final thought to chew on. How much can these big macro factors like tariffs and downturns really derail a company's long-term strategic shift? And what does that ultimately mean for finding value when markets are this choppy?
A critical question for investors right now.
Indeed. And one last time, please remember, everything discussed today was for informational purposes only. It is absolutely not financial advice. Do your own homework before making any investment decisions. Thanks for diving deep with us today.